Okay, good afternoon. This is your weekly take on the market. Today is August 9th. It is 1:15 Pacific time, so the market has closed for the day, Friday, August 9th. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Let's get into the disclaimer. I'm not licensed. I don't make buy, sell, hold recommendations, and I can't tell you what to do with how many stocks to own. I can go on and on about the disclaimer. The reason you kind of go down this road is because we get a lot of emails, and sometimes we have to send back a disclaimer email. It's just not an answerable. It's not a question we can answer under the compliance umbrella. That being said, as you saw previously, I do have a lot of experience. I've been in the market a long, long time. And it's one of the great perks of working in Investors Business Daily is the freedom to invest our own monies freely. And so I'm, like the Hair Club for Men, I'm not only the manager, but I'm a client as well. I use these products to participate, just like a lot of you do. Okay, let's get into the slides. It's been a crazy, crazy week in the market, of course. So there's probably a lot to talk about. We'll do market thoughts, we'll do industry groups, we'll do stocks to watch, and then the quote of the week. So I'm not even going to get into like the whole yen carry trade and the employment number, et cetera, because it's a little bit outside my circle of competence. To be honest, I know enough to be dangerous, but not enough that I'm an expert on any of those things by any stretch. But it sure did create either all of those or none of those, or the combination of those created a crazy volatility event, and the VIX had the largest range on a daily frequency, I think is what this chart is telling you from high to low. I think it got as high as maybe 65 and closed to with a two handle. We'll pull up the chart. So the crazy, crazy volatility. So little off the highs, which is very interesting to me. The market, the S&P is within maybe 5 or 6% of a new high. NASDAQ maybe 10 or 11 or maybe less. It's rallied in a handful of days. So on Monday, you had a really crazy volatility event. And those days and I happened to be on IBD Live that day just by happenstance, and normally not on Mondays, but those are the days, if you have hedges or if you're short, you have to take them off. Now, the market could crash. It's the tiniest possibility that it could, but it's a possibility. It's a tiny possibility. So you have to keep that in mind if you're hedged versus being short. But the odds of that are so small, and the odds of what happened are so very large that you will get some kind of reversal. Normally not within minutes of the open, but usually within a day or two, if not same day later in the day. So, I said on IB Live, if you had hedges, they've done their job. Take the hedges off and then reevaluate, see what the market does. If you're short, you're just forced to cover. I really think that you have to, if not all of it, 90% of it, which is about what I did. I covered, I think there's one stock I covered 80% of, and the other 20%, I'm sorry, I didn't cover it. It's significantly higher than where the 80% I covered, which is frustrating because it's exactly what I thought it was going to do. It rallied like everything. So when you get those type of events, you have to kind of step outside. You're probably feeling a little anxiety. I had some longs too that did not open really well. And so I'm just like, what do I do with these? It's a very surreal feeling for sure. And so experience will help you to kind of get an idea on how to handle it, but it's not easy. It's definitely not easy because the fear can take over. We're all human, and I can know that everybody's being fearful, but I'm being fearful myself. I might get into protective mode as well, because you just start to think, just protect what you have. So it was a really crazy, volatile overnight week so far. That's for sure. And we'll pull up the VIX. I think it's, I don't know though. I don't follow it honestly. The only time I follow it is if it starts to show up on my Twitterverse because of the unusual volatility that occurred. The Russell. This is why I have avoided the Russell, mostly to my benefit. Now, it did have a huge rally, and that was to my detriment, although I didn't short it. I didn't lose, but I missed that trade. And most of the companies in the Russell are unprofitable. So they're highly reliant on borrowing money, which is why maybe with people think that the Fed's going to lower rates, if money gets loose, they can rally. But you can see here on this chart, and I apologize, I don't know where I got this chart. I do this too often. I sincerely apologize. The person that put this chart together, I got it off of somebody I follow on Twitter, and I should have grabbed that the handle, but the percent of unprofitable companies in the S&P is higher than the tech bubble, almost as high as financial crisis, not quite for the COVID crisis, but you get the idea. There's just not a lot of great companies in that index, which is one thing that's kept me away from that, right or wrong, for a while. Let's go on to the next one. So if there's going to be a problem in the market, you always want like these, what we would call canaries in a coal mine. And if you don't know what a canary in a coal mine is, then you're really young, and congratulations. But it's an old saying for a warning sign, and it's hard to know what the canary in the coal mine will be for the next crisis in the market, if it comes, the next bear market, because it will come. We will have another bear market. This could be the start of it. I don't know. I really am on the fence either way on this one. It's really tough. I don't have a strong opinion either way on the overall market as we sit here today. But private equity could be an area. Commercial real estate is something people talk about, but this is the assets under management in private equity, and the part of it is allegedly how they mark their book. It's not really mark to market. One thing that's helped me stay in my house all these years and is that I couldn't get out. If my house was a stock, I think I would have sold it a dozen times in the number of years I've owned it, thinking it was too high and it needed to pull back. So private equity is a little bit like that. It's kind of you're in for a while type thing, and they just mark the books kind of how they mark them. So there's a lot of assets in private equity. So that's an area to watch. And that could be Blackstone, that could be Apollo, which is the one that I'm watching, and I'll pull that chart up later today, APO. But the idea behind like what's going to cause the next crisis is it's always something that we're not thinking about, which makes it difficult to to gauge when it might come. That's why I think just watching the markets in the end, this is all fun and it's intellectually stimulating, but in the end, the market, the smart money, the Stanley Druckenmillers of the world that have all the money, they will vote, and they'll vote with their money, and they'll either push prices down or they'll push prices up. And that's why just watching the charts and looking at them and being in sync with the leadership and the indexes is the best strategy, I think, that we can as individual investors employ. A lot of talk on the Berkshire Hathaway thing that he, really he really reduced his position in Apple, and he is like the second largest holder of 30 years or 20 years or whatever in the world, next to Japan or something like that. And he's got a lot of cash, and you can interpret it a few ways. Mostly people interpret it as he's bearish, right? There's nothing to buy. Maybe he just feels like he's, once the ammo here, when the dust settles, he has some ideas in mind later on. I don't know. It's nothing that I would know for sure, but I do remember in the 90s, late 90s and 2000, how there was talk that kind of Buffett had lost his way. He didn't understand tech stocks, and he was underperforming the market. And I don't know how long that went on for, 6 months, a year, 2 years. I even think he might have been on the cover of like one of the magazines, Business Week or something, with that type of title. Has Buffett lost his touch? And he was early, but spot on as far as the market environment. So interesting that he's mostly, well, I don't want to say mostly, but he does have a lot of cash, and the most that he's had in a while. Now, adjusted for his AUM, that would probably be a better chart. Like, what percentage of his AUM is cash? Would it truly be the highest ever? That would probably be more interesting, to be honest with you. Okay, those are all the charts. One thing about like Twitter can be kind of noisy for sure, but I really like it from a sentiment standpoint. It kind of gives me an idea on where people are. Do they get bearish really fast? Do they talk about buying the dip? And it's not perfect, because you might have one guy saying it's a buy and one guy saying it's a next bear market. But if you have 100 people and 95 of them are telling you it's the next bear market, it might be the next bear market, but it's probably not the next bear market at that very moment, which can be good feedback for you as far as how you position yourself. And as a speculator, because I will speculate on the short side to the downside, that's important. Now, if you just want to sit it out in cash, if prices start to move against you, that there's nothing wrong with that either. I don't see anything wrong with that. It's not for everybody. Short selling is definitely not for everybody. All right, let's go to the indexes. And I'm going to pause my video, so just in case you can't see the chart. And so this is the NASDAQ. So you get this really bad break, and I don't remember where it opened. Let's look at the indexes. I think it opened near the lows. This is a 60-minute. So yeah, it was pretty much first tick was your best tick. So if you had your orders in as far as shorts or hedges on the open, you probably got all the best prices. I know Apple and Nvidia, the best prices were really, really, from my time, 630, 631, 632, something like that, probably. I mean, let's look at Apple, for example. Let's see if I can do like how far back. Yeah, so I mean, you're getting 195, 196, 197, something like that, and the stock's already 216. So, and that's very hard to buy. I know it's not for everyone. It's not the IBD methodology. It's fine. You might say you're an idiot, Scott. You're potentially buying into a crash. It's fine. No problem. It's my money. I could do what I want. I want to speculate based on history, based on my experiences in the market. To me, 19 out of 20 times the market's a buy there. 1 out of 20 it's not, and I'm going to lose money in that case, and I'm okay with that. I think that's worth the risk, especially since I had some shorts coming in, and so I wasn't in a hole. Now, if you're fully long the market and you come in, you go back to the indexes, you're 95% invested, the market opens here, you don't want to go on margin or fill that 5% invested. Now, you might say, I'm going to give it 5, 10, 30 minutes before I start reducing. But so it's back to Warren Buffett. He's credited with the saying, I don't know if it's him or not, but if you find yourself in a hole, stop digging. So if you're, you're down 5% on the day, you don't want to add to that. I wasn't down. I was up, even with the few longs I had that were pulling back because of my shorts. So I could be aggressive. That's just me. I mean, it's not right for everybody. It's just, it is what it is. So you're getting a counter turn rally. And I think the key will be, well, if it's a counter turn, something like this, it's going to probably meet the moving average, something like that. And if it can get through and start to hold up, it could be fine. it could be fine, but, or, so maybe traditionally you wait for a follow through day. So let's go to the S&P 500. And so what's the first day in a follow through day? It's the first blue day. And that'd be day one, that day, Tuesday. Day two was Wednesday. Day three was Thursday. Today was the first time you could potentially get a follow through day. So we would need the market up, I guess 1.25 at least, maybe more. I would prefer more, and the volume higher than the previous day. So today was a blue day. The market was up, but it wasn't, by no means was it a fall through day. NASDAQ was up 0.5%. The volume was, it looks like it might have come in just a little bit under, but so you're not quite there yet. You need a big day. And so this could be like, I was looking at like, if this is going to be a bear market, I go back and study like previous bear markets. How did they set up? And 2007/8 into 2009 was like, to me, the worst bear market that I experienced. The financial, the tech bubble in 2000, I don't know, it didn't bother me as much because the type of companies that went away, that got really in trouble, they were just flawed companies, for lack of a better word. In the crisis, it was like real companies, Citibank, Bank of America, Goldman Sachs, and that made me a little bit more nervous. Maybe I was a little bit older too, so I don't know. But this is, to me, like the worst bear market of my lifetime. And you see, like right here, how the market broke really bad. So if I were to go there, this looks very similar to what we have now, right? You're in a big bull market, market's fine, and then just kind of out of nowhere, it breaks bad. And then if you can just kind of advance this if you want, day by day or week by week, you get a little double bottom, which we might get here. It's not out of the realm. But then the market advances or kind of rights itself, and it rallied and made new highs. So maybe it just shakes this off. Look at that. That's I'm going to presume that's the follow through day right there on March 21st, 2007. You get a little pullback and then off to the races. But then market's in new highs, and again, it looks very similar. You get a bad break in a hurry. So we advance, and the market shakes it off again. The market, so like in hindsight, like the 07/08 crisis, was the top was a process. You got a handful of tops. I think it even makes another new high here. No, maybe it doesn't. This was the new high that I was thinking of. So you made a new high, seemed like all clear, but then you got another bad break. And then this time, it kind of standard, right? Cannot get above the moving average. The moving average is rolling over, and voila, you start to live below this 200-day. That's the key, is the living below that 200-day. Every day below the 200-day on the indexes, you're one more day likely a bear market in my humble estimation. So that's where we are here. So maybe we get something like this. That would really fool everybody. A move into new highs, they'd give you the all clear. And then if we get a second break, I think that would get me even more nervous. So I don't know if we're here, the rally to new highs, or here with the fake out to new lows, or maybe even something like this, where it goes on for a long time. And you don't have to know. So we're here. And then here's the 200 days. So this is such a key moving average. So until we start to live below that, you're just not in like a traditional bear market. You go back and study, the most of the market will live above this line, starts to live below that line. That's when it's pretty tough. Japan. So Japan, it was acting fine. I can't remember when I was long EWJ, sometime in here, but acting fine. And out of nowhere, just a bad break. And you can see it's still below the 200-day. So the longer it stays here, this would be a total avoid. And even for me right now, it's still an avoid. It's just not, the overseas markets just don't have the same umph that US markets have. I don't know why, and I just don't need to know why. It is what it is. It's written plainly on the chart, it seems. The bond market, TLT, and so you had a really big rally, obviously, and that's what it should do if the market is fearful. Almost always bonds will rally, kind of like what happened here. And now it's building probably a cup with handle, and we'll see if it breaks out. Here, I think I'll put like some type of alert there, and be bullish for bonds and probably bearish for equities, something like that. IWM. So it turned out to be the greatest head fake ever. And maybe it could have made money, but it just was really tough, right? 19 days up, 3 days down, all gone. That makes it pretty tough. So just an avoid for me. I don't know. I don't know what it is about the IWM, but just would be an avoid. I think that's it for the indexes. I guess we can include, it's not really an index, but let's briefly talk about Bitcoin. I don't know what it is, if people are interested in Bitcoin, or it seems there's enough of it out there. I haven't the slightest. Probably, you get this type of fear in your Bitcoin. You're looking for something, maybe that's something you buy. I've never owned Bitcoin. I have owned the ETFs very briefly. It did not stay the course very long in them, but it was setting up, and then on weekly, this looks like a pretty good tail. I don't know what to make of Bitcoin. That's I don't have a whole lot there, but it's something that I watch because I think it tends to just kind of trade in line with the NASDAQ. And so if they're willing to take risk in Bitcoin, they're probably okay taking risks other places. Industry groups. Let's go to the 197. Oil and Gas Royalty Trust is number one. Still, steel, specialty alloys, medical long-term care, telecom infrastructure. Okay, now this is interesting. Beverages, non-alcoholic. So look at the move, 61.7 to 5. That would be what I would consider a defensive group. So if it can stay in that top 5, top 10 area and hold up there, that would be defensive, I think. Food, meat products, retail supermarkets, a bit defensive. Media books, tobacco would definitely be defensive. Utility, electric power, I would consider that defensive, improving. So there are some defensive groups in here. So if the market gets better, I'd like to see those defensive groups start to pull down and the offensive groups, for lack of a better term, to move up. Not a lot there on the industry groups outside of that. Let's look at, okay, so not necessarily a stock, but these are my favorite kind of ETFs for sentiment. FANG U, it is a triple up FANG index. So all the moves are exaggerated. Keep that in mind. But if you look at like the weekly, wow. I mean, pretty bearish on this, but I have to respect that type of action. I mean, this is I think they call that like a hammer on a candlestick chart. So not short this. Covered on Monday, and luckily, and it moves a lot. So it didn't have really a very large position because you can make or lose a lot with a small position. So that looks like support. I have to respect that. SMH, not as strong, but it's not triple. This is another one, looks like support. This is the key group, SMH. This is where all the growth is. It's been a bastion of this entire US-led bull market. Look at how from 20 to 300 almost. It's just been such a leader, has all the best companies in there, except I assume Intel is in there. Maybe that's the only laggard or one of the laggards, but This is an ETF I watch big time for sentiment. So I've got this little trend line here, see if it can get above that. And then as it gets in near there, if it does that, I think that'll be the key. If it can get above that, I'd get more bullish. If it turns from there, I'd get more bearish. So right now, I think from that standpoint, you're in no man's land. I'm not short this anymore, SMH. So let's look at the stocks. So let's go with NVIDIA. And this is the leading stock of the bull market. It's the best company, biggest earnings and sales, best narrative. So sometimes I buy this just for that reason alone. I know that might bother some people. I've gotten emails about it, whatever. It's the leader. If I want exposure to the market, that's the one I go to. And in the last couple of times I've gotten stopped out doing that. It's fine. I get it. It's not really for everyone. Maybe just wait for a setup. That would be probably the better way for me. But you see, it feels like it's losing a little bit of its leadership, honestly, because so you have a little bit of a low here, but look at the volume. So not a lot of demand came in on that low. And if I compare that to like the SMH, even though the volume is not bigger than the previous week, but look, at least the SMH closed up for the week, whereas NVIDIA still closed down for the week. So it's losing relative strength very, very quickly. If I go to the panel here, the 3-month RS is 23, and the 6-month RS is 87, losing that RS pretty quickly. I don't remember if I talked about it last week. I think I did, so I'm not going to go down that road. But this is, how can it be a 98 here? Well, in the last 12 months, the stock's gone from, let's say, 40 to 100. That's pretty good performance. So that's why the RS rating over 12 months still very high. Jury's out. It feels like it's losing a little bit of its leadership. Apple, they caught it. Good support that day. It's above the moving average. I think it's just a watch stock. I don't go to that one too often. Amazon, they all kind of look the same. So Apple is off the 50-day, Amazon's in the 200-day. What else is in that group? That's Microsoft. So off the 200-day, and then Meta. And I think Arush was on IBD Live this morning, and I think he talked about Meta. I didn't watch the show too much. I just had it kind of on the background while I was working, but I just say it's pretty good action, and it's RS line's almost to new high. So if you forced me to buy a FANG stock or a big cap tech, this would be the one. Actually, I think it probably looks better than NVIDIA. This should be the one that I should be trading for exposure if I want. So holding up, fine. Let's see if it can hold. Secondary names, something like Palantir, made a new high, and you have to respect that. The earnings are up 80% last quarter, revenue up 27%. I don't know. I don't know if it's buyable right here. It's come a long way from 25 to 30 in a short period of time, but watch list candidate, that type of strength. Lilly, the drug stock. So Lilly is holding up better than Novo. Nice earnings report, up 86%, revenue up 36%. Novo. So you see Novo's below the moving average, whereas Lilly is above. And earnings last quarter, and this isn't perfect. There's no, it doesn't mean that Novo can't go up and Lilly has to. But if you force me to buy one, it's an easy choice. Look at earnings last quarter for Novo, up 2%. I would buy Lilly. Let me just cross these off. Palantir. What others? Oh, Kava, I would consider a secondary name. New name. I thought about buying this today. Pretty good action in this stock. Relative strength line, not quite there, but very close. But look at the weekly bar. I thought this was a bad week in the market, right? So that's a really good action. There's no pivot. There's no buy points. I get it. I understand. I know the rules. I've been doing this a long time. But I don't know if I want to wait for a base because I don't know if it's going to build a base. on a standard time frame, the base count starts here. So is this going to be a base? Maybe, maybe not. So sometimes you can, I know it's not perfect, but you can interpret like a little shakeout +3, and that's how I was going to buy the stock. It looks like a shakeout +3 buy point. It's a little bit more esoteric, but I do not mind buying like that. I've had pretty good success buying stocks like that. They don't all work, but when they work pretty well. The magnitude of the working is much stronger on shakeouts +3 is my experience. So Kava, and then kind of the HWM. So more standard breakouts, broke out of this cup, holding really well. Venom. Did I get this right? No, VNOM. So try to break out and then builds this little handle. To me, this is, if this pattern break didn't exist, this is the cup with what we would call a high handle. Is that such a thing? I don't know. I've heard people talk about that. So the pivot would have been there. So that's acting okay. Shark Ninja had a pretty good breakout. I didn't buy this. It sometimes, I don't know. It's the earnings and sales. Everything about it looks great. I have to get over my kind of disdain's not the right word, but they just make appliances. And so I like what's new, what's innovative, what's exciting about that. But the TAM, like the market, the total addressable market on something like that is tremendous, because everybody needs a blender or a food processor, et cetera. So you don't have to be all that exciting. And maybe they are innovative in their little niche. So I've missed airball on this one for sure. Acted really well there. This looks like the second leg potentially. I want to talk about Chinese stocks. So PDD is acting really well. Again, shakeout +3. I just can't bring myself to buy it. You have earnings in a couple of weeks, but you can see that it's holding up pretty well. And it didn't make a new low while the US market made a new low. Look at these quarterly earnings and sales. So strong. So I watched this one, have not owned it in a long time, more just like watch it and watch it and watch it. But I'm wondering if there might be a place where I need to consider it. It is Chinese. So some people will say, I'm not going to go down that route. It's Chinese stock. And I get that. I've thought that for a handful of years recently. And so I haven't owned anything there for a while. On the energy side, Nextera. So it's setting up nice flat base. I love, look at the volume. Look at how it's just drying up. Now there's no such thing as a flat base cup with handle, but the concept is the same, right? As it approaches new highs, it drifts back and the volume dries up. So this looks very interesting to me. I do own NEE. VST, this looks like a potential like a shakeout +3. So like if pattern break didn't exist, this is how this is a double bottom to me. So what's the traditional pivot? It's 95. I don't want to wait for 95. I'm impatient. So it would, if it shook out below 82.33, a shakeout +3 would be 82.33 plus not necessarily 3, but some number. The shakeout +3 was it's in Bill's book very briefly, but it was on like a $30 stock. So it would be like 82 plus 4 or 5 would be kind of the standard way to play that. So I'm watching this one and I like this energy area. I feel like it's a better way to play the AI field, because no matter who wins in AI, they're going to need energy. So I don't have to pick the winner in AI. Maybe it is NVIDIA. It seems like it is, but I don't have to pick it. They're all going to need energy. So I'll just buy energy stocks, data center / utility / nuclear production facilities, et cetera. So I do own this one because I'll start a position here. I'll buy more through 82 and change if it does that. And then I'll probably buy a tiny bit more through 95 if it does that. And if I'm wrong, I'll stop myself and out and move on to the next one. I don't mind. I don't mind doing that. It's not fun, but I'm looking for risk reward. I'm risking $1 to make $3 as often as possible. If you have some type of edge, you don't have to be right all that time. If you're risking $1 to make $3. There's other stocks in this group like CEG. You could kind of determine the same thing here like that. I've owned this one before. I like VST, at least for me, a little better. Why? Well, one, Duquesne Capital, which is Stanley Druckenmiller, they have a position in VST last reported period. I believe it's around 4% of their portfolio. And two, owners and funds, IBD Mutual Fund Index, Columbia Acorn builds a position last quarter. Is it big? No, 140,000 shares, but they start a position. MFS Growth, they start a position. How about Fidelity Contra? Well, he goes from 370 to 650 to $1.9 million. Seems like the right way. And that's kind of how I've heard Will Danoff talk about how he builds a position. So September, December 2023. So right in here, he has 0.36 million shares. And then the next quarter in December, it went up a little bit. He added 10,000 shares, nothing. And then in March 2024, oh, guess what? Who's creating these kind of ants? Well, his fund was one of them. He doubles his position, 0.85, if I'm reading that right. And then in June, he almost doubles his position again. So I'm curious, at this point, probably maybe he's just sitting out waiting, but that's how they build their positions. You could go along for the ride while they build their positions. I talked about the private equity thing. APO would be the stock to watch. So this is very unusual action. Look at that. That's really bad break. 3 bad breaks. Usually doesn't do that. This stock, plus or minus $1 or $2 every day, almost always. And this is where I should have covered it all. I didn't. I covered 80% of it, so I still have 20%. And, we'll see. If the market gets legs, it's probably going to do that, and I'll get stopped on that 20%. So, but this is canary and coal mine type stuff. Okay, I think that's it for stocks. The quote of the week. Ed Thorpe, he was a hedge fund manager a long time ago. He was a math professor at UC Irvine right here in my backyard. And he wrote a book. Did he write the book? I think so. A Man for All Markets. He also wrote the famous blackjack book called Beat the Dealer. And he's big on the math and edges, et cetera. And he had an interview, I think it was pretty recently. I found it on Twitter somehow. Finding an edge in the market, to me, he's talking about himself, of course, it meant finding a way to do better than investing in index funds. So really, that's what we're trying to do, is do better than in investing in index funds. Otherwise, just invest in index funds. Now, some of you might say, and I probably would be one if you told me I could do exactly as the indexes, no more, no less. But I think I'd still invest in stocks because I like the game. I think it's very stimulating and fun, and so I like to invest in stocks. But in that process, I also am trying to do better than the indexes because that matters. But this is the key for me in what he said. One is to try to get a higher rate of return. And that's what I was always trying to do in my quote unquote younger days. I wanted to just make as much money as possible. The other is to try to get a lower risk. And that might mean doing less than the indexes, but with half the risk. So if I told you I made 30% X year, let's just pretend the year is X. That doesn't give you any information, right? I made 30%. Okay. Well, how much risk did you take? Were you on margin? Were you, or maybe I did that being on average 65% invested the whole year. Maybe the NASDAQ did 60% that year. I did 30 and not all that great, right? Maybe the NASDAQ did 12 that year. I did 30. That's incredible. But maybe I took on incredible amount of leverage and risk. Like my average amount of exposure that year was 172%. So great, I did better than the indexes, but I was supposed to. I took on a lot more risk than the indexes. Now, Ed Thorp was incredible in that he did both. Huge. Like when you listen to the interview, the numbers are almost unbelievable. Like the amount of outperformance and the amount less risk that he's taking. And I don't know what he was using to measure the risk portion, standard deviation, value at risk, VAR. There's a million things you can probably come up with. So this is important. And a lot of you, I think I talk about this a lot, but I really think it's important, especially as I've gotten older, that you don't always have to try to hit it out of the park. The math is really cruel. If you go down 25%, you got to make like 33% to get even. If you go down 10%, you only have to make 11 to get back to even. So not going down is one of the great equalizers of you doing well. And so you have to build that into your model, I think, and try to protect the downside. And to do that, sometimes you have to give up some of the upside. So you have to decide, do you want to beat the indexes? Okay, well then maybe you're going to have to take on more risk than you're comfortable with. If you don't want to take on any risk, then you can't really be upset if the NASDAQ does 30 and you do 20. Because if the NASDAQ did 30 and you did 20, but you were on average 25% invested that whole year, the other portion was in cash, I'd say your risk adjusted return was phenomenal. You did more than, you were a quarter of the investment of the NASDAQ, but yet only underperformed by 50% or whatever the number is, right? So if the NASDAQ did 30 and you did 29 and you were 50% invested on average that year, you did great. You did really, really good. So, and it's hard to know because I couldn't tell you on average how much I'm invested in a whole year. I don't have any kind of tools to manage that, but I know I'm rarely, if ever, 100% invested. The reason I know that is because almost every day I'm going into my account near the close, checking the cash balance and moving that cash balance to a money market fund at Schwab, because I don't want it to sit in their money market making 0.000, whatever they give you. So I have to move that money in. And the next day, if I want it to buy stocks, I have to move it out. And it's a bit of a headache, but it's a process I go through because it's worthwhile. It's real money. It's big money to me. And it makes a difference. So I'm never going to be 100% like the indexes. So I'm on more of taking less risk, and anything close to the indexes is my goal. That's me, and that's just the way I want to do it. Again, if it's not right for you, so be it. That's fine. Find your way, I guess, is the only way I would say it. So here's the numbers. And I have shared in a Founders Club event my numbers in my Roth IRA publicly. Well, I guess publicly it's the Founders Club event. It was a private event, but I don't want to share them here just because I just don't want to hear about it. So In 2011, I started getting serious about this account and tracking it and equity curves and all of that. So in 2011, the S&P did 2.1%. The NASDAQ was down a little bit. Did I outperform those indexes? Yes. By how much? Well, I know, but it could have been a lot, could have been a little. And so you can see, like in 2013, the S&P did 32.4%, but the NASDAQ did 38.3%. And I outperformed the S&P, but not the NASDAQ. So you can put two and two together and you can guess how much I was up, 32.5 to 38.2, somewhere in that range. So I underperformed the NASDAQ. It's fine. The next year, I underperformed both indexes. They did 13 roughly. So I did 12 and change or less. It was a positive year because the only down year I've had since 2011 was 2015. So I have that in red. So the S&P was flat. The NASDAQ was barely up, and I was down a little bit, like high single digits. The next year, yes, 2017 S&P, and you get the idea. So I don't always outperform the market. There's some no's, there's some yeses in here. There's some where I only outperformed one index and not the other, and so be it. So, but overall, this type of performance, I can tell you, is a lot better than the S&P has done in this cumulative, like average performance, and the NASDAQ, but a lot better than the S&P. NASDAQ has been a really tough index to beat. Obviously, for most people, it's been such gangbusters. So you don't have to beat the market every year. There's 1, 2, 3 no's in there. There's some S&Ps and some NASDAQs, and so be it. So by not digging a hole, which is my objective, if I can help it, it helps me to come back and make new highs the next year. So 2024, this year, these numbers are not perfect. Last I looked, the S&P was up around 9. NASDAQ was up around 8. Maybe it's better now because of the rally last few days. But I'm up more than those indexes. A lot of the year, the indexes were up more than me because they were up like 15, 16%, and I wasn't there yet. But we were like two ships passing in the night in the last couple of weeks. So it's like the tortoise and the hare. Just stay steady and try not to worry about what the indexes are doing, what your neighbor's doing, what Joe Smith on Twitter is doing. Worry about what you can control and be content with your process and your objective, and know that, hey, like 2019, S&P did 31%, NASDAQ did 35. I didn't beat those indexes in 2019. Was I up that year? Yeah. Maybe it was 20% or something. I don't know, but that's fine. That's okay. I'm going to continue just to do that because it can build on itself. And the reason I use the Roth is just easier because it's no withdrawals, no deposits. It's just so much easier to track performance. It's the math versus like a margin account where sometimes I put money in, sometimes I take it out, and it's a whole nother thing. All right. I apologize for the length of the video. It's probably longer than I expected, but because I didn't do last week, and with the way the market is, lastly on the market, I don't know. I think I mentioned earlier, I'm torn. I could go either way. I don't have a lot of conviction on both sides, on either side, short side or long side. I do have some longs, I do have some shorts, and I have a lot of cash. I'm not fully invested by any means. And so I'll let it play out and try to see which side wins. Does the downside win? I'll get more short. Does the upside win? I'll get more long and play it that way. All right. 800-831-2525. MarketSurge@investors.com. I do read the emails. We do get your emails. I do read them. Good, bad, or indifferent. Honestly, I see them all. Good, bad, indifferent. I get it. It's fine. You're not going to hurt my feelings if you don't love the video. That's fine. Um, but I appreciate the feedback that I get from all of you. So have a great weekend, and we will see you next week. Thanks a lot. Bye bye.